I don't think the rate matters. I was chatting with someone who told me they recently bought a small horse farm in Dayton, Ohio.
That was not my wife, right? You talk about it privately. We talk about it publicly. This is the Real Estate Insiders Unfiltered podcast. Welcome again to the Real Estate Insiders Unfiltered podcast.
Yeah.
I'm your host, Dwiggy, along with Mr. Robinson, who got to fanboy beyond anything I've seen. So, Keith.
Yeah.
Just tell everybody who your favorite was today.
We had Ivy Zelman, the co-founder of Zelman Associates, on, who I've been a follower of hers for years. She has an economic conference that she runs once a year. It was my go-to to actually, this is one of those weird ones where your idols,
you're in the audience taking notes the whole
when you have one of your idols on a podcast and you're just talking to them about what's going on in their life, and you get to ask the person who you respect, one of the people you respect most, you get to ask them their opinion. It's really special. So I'll shut up now and tell you what she talked about, because golly, it was great for me, and I hope it was great for you. So she talked about a new home slowdown and what she's seeing, the fact that they're having to spend more to get the same number of sales, that why real estate prices could be eroding, and why and how that may shape this market that we're going into. Her thoughts on the stock market, tariffs, all things macroeconomics, which was great, simple. Logic-based. Yeah. Just a great, straightforward conversation. Her thoughts on some of the government cuts, what they could mean. Basically, look, Auntie Ivy came in and she was the voice of reason in an unreasonable time. That's what happened. Okay. She came in and told the kids in the room, me specifically, to calm down. It's going to be okay. And told us why. And if you want that in your life, put it in your ears, kids. You are going to dig it.
Ivy, welcome back to the podcast. We are very excited and honored to have you back on the show. We were, for viewer membership, talking about the beverage of choice that we were having based upon the market and the nonsense that I'm sure we'll go into today. Ooh, doggy.
Yeah.
Ivy, just in case anybody doesn't know who you are, which would be really weird. They'd be living
Surprising.
I don't know where they'd be living, but just give them a little bit about your background real fast. And then we want to dive into all the questions, because we've got you here for a short amount of time and there's a ton of things to talk about. So
Great. Well, happy Easter, everyone. And thanks for having me back.
Yeah.
My background. So I've been a housing analyst for over 30 years, and took the entrepreneurial plunge in 2007 and started Zelman Associates. And since then, I sold the company in 21, but still run the organization. And we provide research on the entire housing ecosystem, as well as investment banking services.
perfect. And for those of you who are recognizing her name, you've seen her on television a lot. So,
yeah.
All right. Well, I'll start with the first question we've got. So
Okay, go.
let's do your take, general take on real estate market today, and then any specifics on what you're seeing in the macro real estate market. So just give us your overview.
Overall, the market is choppy. I'd say that the new home market is seeing still okay demand, though the lack of affordability is really resulting in builders continuing to have to incentivize.
Mm-hmm.
We're seeing base price reductions starting to accelerate as incentives with mortgage rate buydowns. It doesn't really matter if rates come down, because people are so used to having the buydowns. So it's not as effective as it had been. So that's where it's shifting a little bit more to base reductions.
Interesting.
But on the existing home side, we just published our broker survey today, and it's a little backward looking, but we had February results that showed actually a pickup in terms of activity related to pendings. And the closing numbers we think are going to be a little under pressure, but pendings getting better. And I think that's really a function of more listings. But the lever that's not going the right direction is price.
Right.
So we're seeing deceleration, not outright declines broadly, but deceleration. And we think that's going to continue.
So new homes, what I heard you say is over the last few years, they've been having some success with rate buydowns. That's been a primary driver combating affordability, getting people into the showroom to buy new homes. That seems like that is wearing off. They're having to now move to actually lowering price as opposed. Is it in addition to? So they offering the buy down and lowering prices, or are they just shifting away from the buy down because it it doesn't work anymore, or a mix of both?
Well, that's a good question. I'm not sure.
Okay.
I'd have to follow up with that, but I know the net pricing year over year is actually negative in our survey, including incentives, that we're now down about 2% year over year.
So regardless, they're spending more to do the same deal that they were having to do 12 months ago. Regardless of how they're doing that, they are putting more money into the kitty to get buyers in.
I was reading today on an article somewhere that I was seeing something like almost 50% of sellers are putting some sort of concession out now to get things moving. It was in the 40s before. I have to look up where that was, but it was something I was just glancing at earlier today. So there's a lot of movement in that. So are you thinking prices are going to start to, wane a little bit? Is that kind of your general theme over the rest of this year? And we have a lot more questions, but that's the general thesis that you're starting to see.
Absolutely. I think, unfortunately, it's a necessity. And what we've got is a very inflated market. Now, it's very bifurcated, where you have high concentration of new home production in those markets. And really think of the Sun Belt, Florida, Texas, Southwest markets.
Right.
Home prices, doubled, tripled. Those markets are now starting to feel the pain more so than markets where inventory is still very tight. So it's an easy line to draw. So not every market will be brushed with the same stroke. But I think that when you look at, the sellers that are now either motivated sellers, like, anecdotally, a lot of Canadians are leaving South Florida. We hear from brokers, and for obvious reasons, when we have the anti-American sentiment coming out of Canada. But there's definitely a lot of second home sellers, we think, that are saying, I'll take some chips off the table, maybe we'll rent for a while. So I think that it's more of a issue in those hot markets that had been the hottest markets.
I just want to double click on that, because I think we're getting to the place where we're going to start seeing a lot of reporting about, home values plummeting, right? Even though they're off by 0.5%, right? So those headlines are looming and probably heading our direction. And so reinforcing that it's actually healthy for some of these markets to have a pause. We need it from an affordability standpoint. We need it from a just how market cycles work standpoint. I've heard other people refer to this, and I'm curious your thoughts. In the early 2000s, home values went down by something like 1.5% nationally, but almost most of the decrease was located in the Southwest, LA, the Sand States. And it was so bad there that Southern California and the Sand States, that it sort of pulled down the overall number. Is that kind of what you're saying? You're thinking for this year, we'll have some pockets that will see appreciation, some that are going to feel some pain. The net effect might be a negative, but it's always hyperlocal in real estate. Is that?
Yeah, I think so. And I think where you go into markets and inventory is still very constrained, and you have your 3Ds, your divorce, death, default, you're going to have natural turnover. And if there's really not product available and someone could get full offer on a very well-located product that's in good shape, that's what we're hearing.
Yeah.
And even the builders, we had D.R. Horton report last Thursday, first builder for the earnings season, and they fell short of our earnings expectations. Their orders were weaker than expected. They're actually focused more on balancing price over pace, but they indicated that demand is still good. They just require a lot more incentives if they want to sell homes. So I think what we forget is that despite the chaos that we feel in the markets today, the overall employment in this country is still very strong. And as consumers start to get rattled more so, I think things will definitely be impacted. But right now, I'm surprised it's held up, frankly, as much as it has.
Yeah.
Yeah.
And a comment to make on that. So I'm at a function in 2 weeks with all of the top builders. I'm a panelist on a session with them about the class action lawsuits in residential real estate and sort of what impact it's had. And one of the things I'm talking about with the builder CEOs is that they have to stop doing incentives to real estate agents, because technically real estate agents are not allowed to take those incentives per the settlement agreement. It's a big discussion that's starting amongst the builders, is that they're actually causing steering and that they have to move away from that into doing more incentives. So I'm just wondering, when I was thinking about this today, I was on a prep call with the group about, to your point, they're doing concessions. Is it going to move towards price? Because these bonuses they're offering, they're not legally allowed to do it. That's the ironic part. And I guess, is that going to push down? It would push down on resales as well as these things start coming out. It'd be interesting to watch how this affects the whole market on the resale side, Keith. Just all these concessions they're offering potentially, and then the sellers on a resale side are going to have to do something to be competitive in the space on this.
Yeah.
I'm sorry, Keith, go ahead.
No, go ahead, Ivy.
I was just going to say, I'm surprised that realtors are not more assertive with sellers to offer mortgage rate concessions. And, the net effect is the inventory they're holding, they can probably sell it faster. And it doesn't seem it's allowed. It's just not something that's really
the challenge is it's an added layer of complexity, right? So that out of the gate, some percentage of professionals are like, I don't feel comfortable talking about that, right? Which is a disservice to their client. Then the other piece is the psychology, I think, is really different on the resale side, right? If I'm a builder and I have 150 homes that I'm going to be selling out of this development, yeah, if I got to make 20 grand less on each one, but I'll make it up in volume, right? But versus resale, when you talk about making 20 grand less, that's 20 grand directly out of their pocket, and they're going to do this one time, and then they're not going to do it again for 7 to 10 years, right? And so
the reality, though, is they'll have to lower the price 5 times.
Totally agree. Yeah, yes. You're talking logic, and I'm talking psychology, and those two they're not always neighbors.
And to add one more sort of anecdotal point to it, there's a company called Notable that we're familiar with that allows the seller to basically take some money out and remodel their house very quickly and turn it for making it more appealing to consumers. It was on the phone with the CEO today, and he said they've had more orders this weekend than they've seen the entire time for a weekend ever.
Wow.
In just this weekend. He's like, usually the orders come in the week after the holiday weekend or the weekend itself. So it's interesting. You're starting to see, I think, movement of people going, we're going to have to change the market.
Yeah.
So I think part of that too is, they sit longer and they see more for sale signs getting, put out there. But I think if you think about a mortgage rate buy down, and I'm a real estate agent and I'm actually able to get listings, and I speak to my sellers, and my proposal is like, look, if you do a mortgage rate buy down, you're mitigating the lack of affordability.
Yeah.
So therefore, you're going to likely have more demand if you get the rate lower, and you'll stand out. You're the only one doing it. I think it's an easy pitch in today's environment if they're sitting on their, therefore they're listing for a very long time. And right now, the days on market are increasing.
Yeah. For sure.
Way, really directionally.
I absolutely agree. Like if you didn't have the training or the courage to do it in the listing presentation, at a minimum in the price reduction conversation,
right?
Like at least then you're providing at that point the seller with two choices, right? Like, hey, here's a couple options for how we could re-strategize on price.
Right.
Let's shift to the stock market for a second, away from real estate, because no volatility there at all. Ivy, what in the hell is going on? Like just macro, like I get tariffs. I want your opinion on that, but just from a macro standpoint, it just seems crazy. And is that just where we are right now? It's just a roller coaster ride, and it's good what it's going to be.
I think the initial intent by this administration, good intentions, whether we'll get to the desired result is really the big question mark. But I do think that one of the challenges that all the administrations have had that they've not addressed is this massive deficit.
Right.
Well, with $37 trillion deficit, where we now have in 2025, we've got $9.2 trillion that needs to be refinanced. And that debt was locked in at the short end of the curve.
Mm-hmm.
But I think this administration wanted to do was bring down the long end of the curve by slowing the economy. And whether that was going to be from, the risk of jobs being pruned in DC, or we're going to see just more, risk of tariffs slowing the economy down. Maybe that was sort of the intention, was to get the long end of the curve down, but that actually backfired, as we're seeing not only a weak dollar hurt overall the 10-year yield, but we're also seeing some of the foreign owners of our treasuries that don't want to own them anymore.
So backing away.
Yeah. So I think that maybe wasn't what they expected. And when we look at tariffs, it's kind of been chaotic, right? One day it's one thing and the next day it changes. And, it's very difficult for businesses to plan.
Right.
And I'm on a board of a building products distribution business that sources much of their product from Asia, from China, and trying to figure out, should we build capacity in the U.S. And that's not only a significant timeline, a significant cost, but if we do so, it's going to be a lower margin business. But what happens if a new administration comes in and they reverse everything?
Right.
So there's a lot of uncertainty on directionally what should companies actually, how do they plan? And that's making it more difficult. And that likely will slow their capital expenditure programs. And they'll be trying to deal with, sourcing, switching supply chains. Will that affect delivery and securing product? And we did see in our building product survey, March, which we just published, showed that we actually saw a very strong March as there was a lot of pre-buying in front of the building product tariffs that are supposedly going to get implemented. So I don't have a lot of good insights to whether or not things are going to stabilize at some point, but it feels like we're going to see a little bit more pain, I think, before we get to that point.
Can I
go ahead, James?
I just want to ask this because I'm less educated as you both when it comes to the economy. That's what the crazy uncle part here is for. I just don't understand this logic, and maybe help me do it. I'm just trying to be very simple. I don't understand how we expect to bring all of these jobs back to the United States. And I'm asking a very simple question. The cost for labor, minimum wage, all of these things in this country are just massively more expensive than, other developing countries. And I'm so confused on how we're going to be able to make that work the reason why I asked this question is there's already exemptions happening where iPhones can still be made over in China because we don't want to pay $4,000 for an iPhone. Like, partially joking, partially being a smart ass, partially actually serious question. How the hell is this going to operate and get companies to invest? Because what you said was the very thing I was thinking. Well, if I make the investment now in 4 years, it's a change of direction. Mm-hmm. Then that's a massive investment for a company to try and do it logistically and then deal with the same problem as to why they went overseas to begin with. Am I off? Like, am I thinking about this wrong?
It's a logical path for you to be thinking through. And I think a lot of what the challenge for our government is that we are spending more than we're earning. Mm-hmm. And when we look at 80 years ago, after World War II, when we were generating 50% of GDP as a nation, basically we had to help the rest of the world. But it's 80 years later, and we're still helping the rest of the world. We're providing defense for many countries. The tariffs that we are implemented on our products, we didn't have reciprocal tariffs. So I think they're trying to generate more revenue because their expenses need to come down. We need to generate more revenue. Whether we actually get real big movement of jobs back in the U.S., as much as they'd like to balance out the surpluses other nations have with our deficit. I don't know if they really are expecting all these jobs to come back, in my mind, but do they want to negotiate with these other countries and using this as a big stick to do so? And it's not looking very good when you hear Hong Kong is going to stop mailing all of our medications and we have pharmaceutical challenges as a rebuttal that maybe the Trump administration didn't expect that they would do that and they would be more willing to just, acquiesce. So that's where the execution and the outcome becomes much more cloudy.
Yeah, I had a little. I don't think first of all, let's start with Ivy may have some idea because she runs in, highfalutin circles. I have no freaking idea. But I did stay at a Holiday Inn Express last night, so I'll share my opinion. Look, we don't need more jobs right now. Jobs are fine. Everybody's employed. We don't have an employment issue, right? And so, I think we have to stop looking at it binary, like all these jobs. There'll be some job. Like, let's say we got to wait till everything settles, right? How do we work? Do we cut a deal with China or not? Everyone else, is it stick at that 10% number for the most part? And that's what it is. Well, then there will be some small instances in which that 10% differential might make sense to move that factory, that fab, whatever, to the United States. But until the dust settles, you won't know how to do the math, which I think is what Ivy is saying is you can't answer the question until you know how they're going to be doing the math. But this isn't a jobs play, in my opinion. Though, if that's what you said to get elected, you probably have to say that into a microphone every other day to remind people why they voted for you, right? So, Ivy, you had something to add?
Yeah, I was just going to say, one interview I watched with Scott Bessent, who, by the way, we feel like we collectively, Wall Street, is the reasonable voice in the room.
Agreed.
And, feel more confident that he's there at the helm. But what I would say about the interview that stood out to me is that part of what the administration at least wants to do is utilize this as for the working class, sort of as a reduction in provide a tax reduction, whether it's not taxing them on tips or finding ways to reduce their cost, enabling them to do more as, a class of society that's sort of been left in the dark.
Sure.
And so this is like the first time that we're really focused on the working class people out there. So maybe they can earn more income. To your point earlier, how are you going to be able to afford to pay them? Well, if they're not paying income tax, or if you go that far, I don't think they're going that far, but that has been discussed. People make under $50,000 don't have to pay income tax. Would that change the game for them? And therefore, they can afford to buy more, and it would be more possible for people to get out of the hole that they're in.
More upwardly mobile. Yeah.
Ivy, do you think that this, I'm putting you on the spot here, but do you think that this approach, let's leave out the specifics of it, but this idea of Doge, or we'll just call it government cuts, just reducing government, is this a smart move to do in the long run? Is it is it going to make any difference, or is it where we have to make much bigger, deeper conversations about really big expenditures that need to be looked at in order to get rid of this deficit and debt? Two different things.
Well, I'm not an expert on the deficit, but from what I understand, the biggest spending is in defense and healthcare. And so what we really need to attack is not, the smaller parts of government, but the biggest ones, which are the most controversial. But my daughter, who's now 20, I remember when she was 16, and we were having a discussion about the economy, and she said, your generation, Mom, has handed us a bag of rocks. And you kind of have to say, maybe, she's right.
She's not wrong.
No.
And so when we think about how do we balance our budget, how do we get to a place where we're not in the red isn't so blood, ridden? How do we ever get there? It's going to be painful.
Yeah.
How we get there is going to be painful. And that's why no one's ever taken really the task on. And yet for my daughter and assumingly my future grandchildren, we need to do something.
Yeah.
Is this the right way that they're going about it? It's the first attempt. Maybe they'll have to change course. Maybe they'll have to try other things. But I think directionally, I'm glad that someone's finally attacking it.
I'm with you. I'm with you 100%. So we need to start somewhere. It may not be the right approach, and that's all debatable, but everybody knows you can't spend more than you take in. At some point, that becomes a problem.
Well, one of the things I wanted to pin again, because I don't hear it get mentioned enough, and you talked a little bit about the deficit. We took the debt on at the short end of the yield curve, meaning, just in case someone's doesn't have Bloomberg on 24/7. That just means when you took the debt, it was cheap. And then the high end of the yield curve just means when you're going to refinance it, it's more expensive because you had it so cheap originally, which is what we're heading into, right? I mean, we have a tremendous amount of money that we are going to have to restructure that debt as a nation. I think it's in the next 18 months. Can you just frame that up for everyone one more time? Because I don't feel like it gets talked about enough. And it, to me, like, it's the one that I lose sleep over a fair bit, right? Because if we don't solve that problem, you can get into the debt spiral. And don't read Ray Dalio's new book. You'll want to jump off a roof, right? So can you just unpack that for folks, maybe in like a 8th grade level so that I can understand it?
Yeah, I mean, I'll certainly try. I think the reality is that, if we think about our own personal balance sheets, we have, and how much we're spending as individuals, they're spending, if we spend beyond our means, and then we're, using our credit cards to pay for our daily spending, that's not a formula for success longer term. So the government has basically been doing just that, continuing to issue debt that they have to pay back, and doing so at the short end of the curve, meaning a short duration bond that they will have to pay back in a short period of time. Now they'd like to refinance that debt into the longer duration bonds, call a 10-year bond, but the bond on the long end of the curve is still too high when you're dealing with $9.2 trillion that's coming due this year. But keep in mind, our interest expense is $1 trillion a year. So I think the direction of trying to restructure the debt, trying to get rates to come down is a necessity. And also when we're issuing debt, who's going to buy that debt? So if the foreign demand starts to subside, that's concerning, which I think is about 15% of outstanding debt. So I don't know if that helps explain it to the sense. It's funny because my friend who's she's an intelligent woman, but very concerned about what the Trump administration is doing. She lives out in California. And after I explained how simple what we need to do, she's like, that's so clear. I don't know why the media doesn't talk about it.
Right. Yeah. Yeah.
Well, that's a whole other
Yeah.
podcast.
Yeah. It's hard to fight
this-
when it makes that much sense.
Is this why, again, going off cuff here a little bit, is this why the president's so down on Powell right now? Is because they want rates cut. They want the Feds to cut rates to make this easier. Is that the general thesis?
There's some history there too, but I'll let Ivy
I'm with
answer.
you, but I'm just following the path here.
Yep.
Yeah, definitely. His desire to get rates down is almost, in my opinion, a knee-jerk reaction because the long end's not coming down. Because Powell can't control the long end of the curve; he can only control the short end of the curve. So, and the analogy people are looking at is back in the '70s with Nixon, and when I think it was Arthur Blank was put into the position as chairman of the Fed, who was manipulated by the president at that time. So there's definitely been precedent for that. And I think it's very concerning.
Yeah. Yeah. But yes, the short answer, I believe, in my opinion, the reason he's going to a microphone saying this dummy should be lowering interest rates is because he needs interest rates down. And it's moving in the wrong direction, whether they planned for that or didn't plan for that or had it as a possible hedge, who knows? But the fact is that interest rates aren't moving in the direction that we need as a nation for some of the decisions we have to do. To me, this isn't a Trump thing. I don't feel like it's almost become so polarized today that you can't not be polarized. Like you can't just have a logic based discussion, but I still will fight the good fight to be able to do that. Like for the United States of America, interest rates going down and restructuring this debt is really, really important. Now, I don't personally agree with trying to bully someone in a microphone out of their job is the best way to do that. But we do have to figure out, hopefully, how to make that happen because it's an important moment in time over this next 18 months.
Absolutely.
So the tariff noise seems to be calming down a little, sort of, but not really. There's a pause. Great. Markets seem to like that. But then now there's a shouting match between chairman of the Fed and the president. Markets don't like that. Like, how much of this volatility are we through? Like, are we in the first inning of volatility? Are we in the eighth inning of volatility? To use a baseball analogy, you can pick yours. Is this starting to calm down, or is this really just getting rolling?
Unfortunately, I feel like it's the latter.
Yeah.
I think we're just getting started because there's so much negotiations that need to come to fruition. We look at the 10% tariff across the board, assuming that was to stick, and look at what the impact would be on building homes, for example. We're looking at probably in the mid-single digit increase in a home. So call it $10,000, $15,000 a home on a median priced home. So recognizing if that would come to fruition, it's manageable.
Right.
Keep in mind, most consumers are not going to feel that increase because there's not enough demand.
Right.
Given challenges with affordability. So likely going to be a margin pressure story for either the manufacturers, distributors, or builders.
Or everybody, right?
Consumer is going to really feel it.
Mm-hmm.
But with that said, those companies, if they're struggling and their margins are under pressure, guess what happens? They don't hire as much, or they have headcount reductions, and therefore you do start to impact jobs. But to your point, Keith, earlier, we're at 4% unemployment.
Right.
And even if we went to 6% unemployment,
we're fine.
We still would have a relatively pretty strong job backdrop. So I think we have ability to see some pressure on unemployment that hasn't come to fruition yet. That would likely result, if we did start to see a lot more layoffs and jobless claims increasing, we'd probably see the long end of the curve weaken.
Right.
But the worst scenario that I'm really afraid of is stagflation,
right,
where we'll have inflation from tariffs, but we also will have a very sluggish economy.
Yeah.
And this is not where we want to be. And that's what it's looking like it's coming to fruition, which is, I think, why the market is down as much as it is today, is that's becoming, unfortunately, more of what the reality might start to feel. And when you think about, the conversation with Powell and all that drama that I think Trump is very good at providing, also think of the drama heating up with China. And an escalating trade war that could turn into a military war. And that's really scary. So I think people are, really frozen in place. And, those, I laugh with my colleagues. I'm like, I can't believe anybody's still buying a house. But, when you think about the general population, people's lives, they move on. And I think I looked at how many millennials actually and Gen Z own stocks. And it was surprising. It was probably in the, I want to say 60%.
Yeah.
which is much more than it used to be.
Yeah.
That might just be with, meme stocks and everything that happened during COVID and a lot more people that have made money in crypto. But it feels like there's more exposure, yet there's still new home sales going on and existing home sales it's happening. So do people have their head in the sand, or they feel that confident about their personal balance sheet and personal income statement? Those are things that, to me, it's mind blowing to me that anybody would be doing anything right now other than hunker down.
Yeah.
But also they just turn stuff off. I mean, I think there's an element of the world is so over just dramatization of everything has just made people numb to stuff. And then to your comment, it's very polarizing. Like to Democrats, Trump is the devil. And to Republicans, he's a saint, and you're never going to change anybody's opinions on that. So to some degree, no matter what you say about policy on either party, people just ignore anything else about it at this point. So I'm almost like, when I talk to people, I mean, I asked some questions the other day, like, what do you think about this? And they're like, I have no idea what you're talking about. Like, not a clue. Not even the slightest clue.
Just they're in overwhelm.
Yeah.
Yeah. Yeah.
Just turn it all off. They're just like, whatever.
Yeah, that's head in the sand. Yeah. Makes sense. I mean, I do think we all have reached some critical mass of ability to process the drama.
Those lives move on. They are thinking about their personal situation, and maybe they think they're getting a good deal now. I don't know. I know that there's a lot more cautiousness from people that are in finance and in real estate and understand what's going on. But if you're called a layman, maybe it's just not that prevalent to you, that it's not in your face. Like we live it every day. Right. We eat, breathe, and live it. So
I do think we've proven over the last 3 years going into this year that there's about 4 million people, slightly more, that are going to move every year regardless, right? Like that is, we've proven that the floor is 4 million and on the resale side, and that many transactions are going to happen because it's been a crazy 3 years, and affordability, fastest price increase in interest rates, blah, blah, blah. So there's a bedrock there of death, divorce, the reasons that are stimulative to, like, I'm not thinking about moving. I have to move, right? I'm going to buy something new. But it is curious. It's interesting because as a logic exercise, you would want to rent, but I guess considering the American dream isn't dead. We still want to own our home. I got one more macro market thing, and then we'll ask you some interest rates and wrap with a couple more questions. So, stock market volatility. You touched on this once, and the team that for the company that James and I run, they hate me because I text them every day with updates on the 10-year. Right? Yeah, I know they just tune it out, but I can't help it. So weirdness in the 10-year, normally they are, they're not causal, but correlative. If the market tends to go down, rates tend to go down. We're seeing that trend being bucked. You've hinted at it a couple different times with some of your answers, but can you just explain for the lay person? Normally, I think stock market goes down, interest rates go down. It may be bad for my 401k, but it's good for real estate, so I can sleep at night. Why is this trend being bucked right now? Why is the 10-year particularly sticky?
Well, I think a combination of factors is that you have the risk of inflation. Mm-hmm. So tariffs are, pretty much historically been the cause of inflation. So now that's one reason why yields would go higher. And secondly, you also have pressure from foreign sellers with a weak dollar. And I think those are the dynamics that are fighting the other flip side, which is economy slowing would reduce rates. So mm-hmm. It's a bit of a tug of war right now. And we're not sure where it goes from here, but I think that it's concerning that the weak dollar could put pressure in front of what would be further losses for foreign holders, that they would more likely get in front of that and try to sell before they see further pressure on the dollar. Right. So that to me makes me think it's kind of range bound right now and possibly even could trend up a bit.
Gotcha. So we're here for a little while with this.
Feels that way.
Just
until we have more clarity on will in fact tariffs bring inflation.
Right.
And I think hopefully that 90-day timeframe will give us some clarity and we'll have more information to have stability.
I have just realized I'm going to skip all meetings with Keith Robinson the next 90 days.
It's a good idea.
He's going to be in a very depressed state.
I mean, it's, there's a reason to wake up every morning to see what's happening. Yeah, I mean, it's interesting times. Not the interesting times I rooted for, but it's the interesting times I got. James, you want to take the next one? Or you
Um,
want me to run with it?
no, I guess so. I mean, I think I have the answer, but are you feeling, we're obviously out of Q1. You feeling more optimistic on the real estate side today than you were January? I mean, I think I already know the answer to this. So let me ask you this. You're watching all this stuff. Let me change my question. You're watching a lot of the stuff in residential real estate. I'm assuming you're watching the headlines and some of the debates and things that are happening within the industry. Do you feel like a lot of the drama in residential real estate is going to sort itself out? Is it going to affect buyers or sellers just in general? Like, there's conversations about seller privacy, conversations about, open market of putting properties on the greater marketplace. Do you have any thoughts or feedback on any of the drama that's happening within the residential side of things? I'm sure you're watching the headlines about too.
Honestly, I'm not as familiar with all the drama
Okay.
because we really wait for things to come to fruition rather
Sure.
than dealing with that. But you tell me, you're closer to it.
I don't know. I worry. I just there's just a lot of movement of. Let me put it this way: companies are, to Keith's comment, we're dealing with 4 million units. We've been there for basically 3 years, right? And I don't know. Keith and I are projecting 4.2 million potential resale this year. I don't even know if we're going to hit that at this point, but
We will.
Hoping Keith's right.
But we're outpacing last year right now. So, but continue.
Companies are getting very creative on how to do as many deals in house, and some of those tactics are talking to consumers about not putting their home on the open market, Zillow, Trulia, Redfin, et cetera. There's just a big debates going on, and I worry after reputation damage in our business that we've had over the past few years that there's just more to come, just due to companies are trying to figure out how to get a bottom line. I get it. And I get it. And from a business perspective, I totally understand. I think there's just a significant amount of movement into our space. I know you can't get specific, Ivy, so I won't ask the question, but there's a lot of movement into our space about companies trying to find ways to get up funnel and cut that transaction cost from, an average 40,000 when you look at both sides of the real estate commission, title, financing, et cetera, and cut those in half. And we're also trying to figure out, where does this all end up? What does it look like long term? What does it mean to the consumer? Do they still use representation, or is it more of an automated basis? Do you have any thoughts around any of that that you're willing to share on where you think the industry looks like?
Well, I definitely think the consumer will always need representation, especially that first-time buyer who's not as sophisticated. So companies will offer that. How that will be structured, and if the drama unfolds, we're seeing consolidation in the industry. Margins are already very thin, to your point. I don't know that there is a crystal ball to directionally say, will that change the dynamics of the industry? But I believe wholeheartedly that consumers will always need real estate agents to represent them. And therefore, at least that gives me a foundation that these agents out there are a very needed part of the transaction.
Mm-hmm. It's just a matter of what capacity that is, how that functions. Yeah.
Yes.
Yeah.
I think that's a fair statement too. I have the same viewpoint. I think our role shifts quite a bit, but I have these conversations often. It's like, the realtor is going to go away. I'm like, people don't.
No, they're not. This
is such an infrequent transaction. They want somebody to help guide them. How they guide them and what that fee is debatable, but
sure. And it always has been.
Yeah, for sure. All right, Keith, take us home.
All right. I got one more. Cause we can't have you on and not ask you about interest rates, right? I mean, that's almost criminal. So just, if you could just let us know when rates are going to get below 6.5 and stay there, Ivy, if you could tell me that date, so I could plan accordingly, that would be ideal. No, joking, of course, but I have a belief. We saw last year, rates got below 6.5, stayed there for a little while, bounced between 6.5. We had a pretty good rebound in buyers coming into the marketplace, and they had enough time to transact. So in my head, been thinking a lot about this year at some point, fingers crossed, knock on wood, we're going to get there again below 6.5 and stay there for a little while, 60, 90 days at least. And that'll be a window where, if you're on the residential resale side, you have an opportunity to take action, take big action, get your buyers in. One, do you agree with that hypothesis? And then two, I know you can't give us a specific date, but do you think we'll get below 6.5 this year? So do you agree with the hypothesis, and then thoughts on the hypothesis as a business approach?
I think that rates are important, and whether they go below 6.5 or they stay at 6.83, I think was the most recent data from Freddie Mac. I don't know that it's going to matter that much. I know that people think there's a magic rate. I think it's more that the consumer has to feel confident and be employed. Those trump rates.
Right.
And people are in the market today because there's fatigue of waiting.
Yeah.
And there's also people that have locked in or want to lock in a lot of gains that they have, or they can't afford their property taxes because their home has gone up so much in value and they felt very house rich, but now they're poor. So they're forced to sell. So I think the dynamics of the transactions we're seeing today are a lot more about people wanting to get out of the market, relocate, or get rid of a second home, or just go rent for a while. They're nervous, but the buyers in the market, they're likely having lifestyle changes.
Right.
And that could be they're getting married, they're having children. I don't think the rate matters. I was chatting with someone who told me they recently bought a small horse farm in Dayton, Ohio.
That was not my wife, right?
Wasn't your wife. But they were, oh yeah, rates are 7. So what? Yeah, we want it.
Yeah.
And yet, to me, the idea of a 7% mortgage rate, 3 years ago, you go, oh my God, that's going to kill the market. But to your point earlier, Keith, you talked about the job market being as strong as it is.
Right.
So I don't think 30 basis points, one direction, 50 basis points will matter very much. What matters is how people are feeling about their outlook. So, more so.
Not a great point.
Water on your thoughts, but
it's people buy because of timing in their life, not timing in the market. Right.
We say that all the time,
Yep.
And sometimes we talk to people about it. There never is necessarily the right moment. Sometimes you just got to jump in and do it. So,
well, remember back in 2009, affordability was at record low or the highest affordability, and yet people weren't buying because they were worried. They were worried that home prices can keep going down, and they were worried about their jobs. And we really weren't out of that recession. So I think that just gives you sort of at least roadmap to what really drives.
What was crazy is I went and looked, and back then we were doing more there were 4.6 million resale transactions in 2008 and 2009. We're doing 4.1, 4.2 million, 4 million now. That for me, I don't know why, because it was going through this and I was like, this feels harder than 2009. And I was trying to blame it on I'm 50 now, not whatever I was back then. but it turns out this is actually statistically also worse. There were fewer real estate transactions than there were in the downturn.
True. However, that's only due to the fact that we had foreclosures and short sales that were driving the market. So I think it does feel better despite transactions being at 35-year lows and we're kind of stuck at that 4 million. And I'd like to believe that we're at a bottom too. And our forecast actually for 2025 is to have a 5% increase in existing home sales, which is not much off of trough levels. But we could go lower. There's no question we could. And yet, because of the motivated sellers that have lots of equity, I think there'll be a lot more willingness to take chips off the table and transact. And with inventories up, I'm optimistic.
Yeah,
I know for the real estate agents, this is an opportunity to capitalize on, I guess, fear.
Yeah.
If I'm doing a seller presentation, I'm going to be all over the risks that are inherent in the next 12 to 18 months, and the volatility in the market can only make housing even more challenging. So you better sell now.
Right.
And show them the data.
Yeah. Interesting. Well, Ivy said it's going to get better. That's all I needed to hear today.
Are you guys still on that forecast?
If you're a real estate agent, I think it's if you think about everything that's going on, real estate agents they care, of course, for their clients, but if prices are up or down, they're making money, maybe a little less if prices going down.
Of course.
This transaction, it might be one of the best seats to have right now. Be a real estate agent in the ecosystem for housing. Because
units are going to, you're holding firm on that 5% bump. You aren't going to revise that.
Yeah, well, of course we could, but we do it quarterly right now. Like you said, where we are in March and what we're seeing indicates that the demand is still, moving in the right direction.
Yeah. I mean, we're ahead of last year's pace going into this year. So Ivy, as always, you're the voice of reason, of sanity. I love it when we get to have you on to sort of calm me down. So I appreciate you.
I feel better.
I do too. Every time. Yeah. Every time.
I think it's just telling people directly, just in very simple terms, just allows everyone to digest this. So, because you read the headlines and you're just like, man, Keith and I always say, like, I gotta invest in canned peaches and ammunition or something.
Yeah, it's getting bad.
Never mind. So,
investing in tomatoes.
Yeah.
Exactly.
We had the National Association of Home Builders CEO and the Chief Advocacy Officer on our podcast. It was a really fun interview, and we were joking about how builders in 2010 were investing in bunkers.
Yeah, building bunkers. Yeah.
Building bunkers.
Yeah.
So
there's some people building bunkers now.
There for sure. There are for
we'll
sure.
Edit that out. So.
Yeah, we're leaving it in. Ivy, you're the best. Thank you again so much.
Appreciate you.
Yeah.
Thank you.
Yes, we want you to subscribe to this podcast, but the good news is if you subscribe now, you'll never have to subscribe to any other podcast ever again.